Hi traders, I'm Aman and welcome back to SMC Wolf FX. Today we're breaking down a powerful smart money concept trading the Asian session range. If you've ever, for example, been caught on the wrong side of a London move, this is the blueprint that will flip the game for you. Let's get into it. The Asian session runs from 7 p.m. to midnight New York Eastern Time. Of course, you may have seen different time zones used online for the Asian range, but this is what I use. During this window, price usually moves sideways in a tight low volatility range, but that's not random. It's assumed that it is intentional liquidity engineering. Institutions use this session to accumulate orders and build up traps, setting clean highs and lows for the next session to hunt. This works because it's assumed that this is how smart money traps all of the retail traders. Basically, they let the market range in Asia, they set clean highs and clean lows. Then London, as an example, comes in with volume and sweeps the liquidity before reversing towards the true market direction. So basically, retail gets trapped, smart money takes the other side. Also, by the way, if you're finding this useful and want to learn the full SMC framework, I offer private one-to-one mentorship. You can head to smcwolffx.com and get in touch. So here's how to trade this live. This is a quick example in theory. Before London opens, mark out your Asian high and Asian low. Wait for a liquidity grab during the London session. Either the high or the low gets swept. And then you want to look for your entry confirmation, whether that's a market structure shift, fair value gap, order block, displacement, whatever fits your plan. And then you'd want to target the opposite end of the range or ride the move with a trailing stop if you have a higher time frame perspective which supports continuation. Here's a quick illustrative example of how we can use the Asian session to picture out trades during the London trading session. So let's assume this is the start of our Asian session being 7 p.m. Eastern Time, and this is our end being midnight, 12 a.m. Eastern Time. And our Asian trading range is a tight consolidation price action phase. So as our London trading session opens, what we can do is we can mark our Asian highs, and we can also mark our Asian lows. So when price forms this type of price action, which it does form quite frequently across forex pairs, when it's a tight sideways consolidation during the Asian trading range, we can assume that there is liquidity sitting both above the Asian range and below the Asian range. So assume our general daily bias is bearish. We'd want to be looking for shorts. So ideally, what you'd want to expect to happen during the London Open is for price to take out topside liquidity in the form of Asian highs, and then to continue on bearish, trading towards the Asian lows. So say that's exactly what happens. We take out topside liquidity in the form of Asian highs, and then we start trading bearish towards the Asian lows. So how you can use this as a trading strategy is when you see one side of the Asian trading range being purged, you can then wait for confluences to occur in the form of, say, a fair value gap or a market structure shift, order block, or whatever that you use to trade as per your plan. So in this case, let's say we've got a order block formed here, a bearish order block formed. We'll call it we'll just keep it simple, call it order block. And so, of course, price has taken the Asian high, so the liquidity on the top side, and then we start to trade bearish, leaving behind a bearish order block, which we can then use for a sell entry as soon as price taps into it. And then you can set your your stop loss just above the order block, and I will take profit at the next area of liquidity, which would be the Asian low. Now, here's an example of the Asian trading range working on the actual charts. This pair is GBP USD. So before I get into it, there's an indicator that I use which automatically marks out the Asian session for me automatically. That indicator is called FX Market Sessions, the one by Boy Toki. And here are my settings. So of course, like you can just put in like a trading session here and then put in whichever time. So here's the Asian one, and then I've got it from 7 p.m. Eastern time to midnight Eastern time, being the New York time. Anyways, in this example, you can see that the Asian range was a tight sideways range, which is perfect. So we can assume that there is liquidity sitting above and both below this trading range. And then as we get into the London trading session, you can see that the price opened towards the downside, taking out the sell side liquidity. So the liquidity which is resting below the Asian trading range. And after it went below the Asian range, price consolidated a little bit. And then we traded bullish towards the upside, taking the Asian high. So the liquidity which sits on the top side of the Asian range. So now you may be asking, well, Aman, great, but how can I use this as a trade? How can I use this as a trading strategy? So as mentioned before, when you see the Asian range being sideways, in this case, this is a tight sideways consolidation. You can wait for the market to take one side of the Asian range out, so one side of the liquidity out. Once it's done that, you can then wait for an entry confirmation to then trade price towards the other side of opposing liquidity. In this case, once we went to the downside, price it went sideways, and then it did another form of liquidity sweep over here. And then after doing that, we had some impulse candles as a result, leaving behind a fair value gap. So this is a 5-minute chart. So here is a 5-minute fair value gap. Of course, if you don't know what a fair value gap is, just do a YouTube search. There's a bunch of videos teaching, well, what a fair value gap is. Anyways, this fair value gap was created. So this could have been your entry point. This next candle tapped into it. So you could have put an entry as soon as it came back into the fair value gap. You could have put your stop, say, at the previous low, and then you'll take profit at the opposing area of liquidity, which in this case, well, for the purpose of this video, being the Asian high. And as you can clearly see, that gives a pretty good trade with a good return. All right, if we go through one more example, so if we just go to the next day, again, you can see here, we've got the Asian range. Again, it's a sideways consolidation range, which is perfect. So we can do the same again. We can assume there's liquidity sitting on both sides of this trading session. As the London session opened, you can see we wicked the Asian lows first. So here's our liquidity sweep right here. And let's just type it in, Asian lows. So again, the liquidity has been taken. And then if we're looking for an entry to target the opposite side of liquidity, being the Asian highs, just be patient, wait for something to form, which you can enter off. In this case, we had impulse candles. So exact same thing as the previous trading day. In this example, we had a 5-minute fair value gap left behind. So I'm just marking that out right now. So 5-minute fair value gap. Let me zoom in a little bit so you can see what a fair value gap is. So you got this first candle, which is a liquidity sweep of the Asian low. Then you got an impulse candle, which leaves behind an imbalance. This third candle, again, the wick low. So basically you've got an imbalance of this price area here. So the high of this candle, the low of this candle, this can be defined as a fair value gap. So as soon as price trades back into this fair value gap price region, you can place an entry. So let's just do that just for purposes of this quick example. So as soon as price entered, we put a manual entry in place, say, and then we can put our stop loss again at a low, and I'll take profit at the next level of opposing liquidity, in this case being the Asian highs. And yeah, so if you, of course, go back to your charts, test it on like a number of different trading pairs, and you'll find when you have an Asian trading range where the Asian session is a tight sideways consolidation where it's just bouncing around, it's not trended or anything, just completely sideways, you can then see that during the London trading session or even into the New York trading session, when you have one side of the market get taken out, so one side of liquidity get taken out, whether it's the Asian high or the Asian low, you can then assume that price is now going to trade the opposite direction, taking out the opposing area of liquidity. And this happens every single week, week on week. And this can be a standalone trading strategy, which you guys can use for the London trading session, and it works really well. This is something I use quite religiously. If you're part of my Discord group, it's like you'll see that I love trading the Asian range, and especially being on the right side of the market when liquidity gets taken out. Then you wait for some form of high quality confluences such as order blocks or fair value gaps or even the Fibonacci retracement, whatever it is. But yeah, guys, honestly, I hope you found this video useful. But yeah, this is a good strategy. Back test it and see how you get on with it. And that wraps up today's breakdown on trading the Asian session range. If you found value in this, make sure to like, subscribe, and hit the bell icon so you never miss a video. If you have questions, drop them below in the comments. And if you're ready to level up your trading and want personal guidance, check out the one-to-one mentorship at smcwolffx.com. Thank you for watching. This is Aman from SMC Wolf FX. Trade smart, trade disciplined, and I'll see you in the next video.